Hello friends. If you collect Social Security and also draw from a traditional IRA or 401k to cover your living expenses, the next few minutes could change how you look at every deposit from here on. Your Social Security deposit arrives this month. Before you spend a single dollar, a 40-year-old formula has already run in the background. Anywhere from 0 to 85% of that benefit is already taxable income. No letter explains this. When you open your IRA for a living expense, that withdrawal also feeds into provisional income, the number the IRS uses to determine how much of your Social Security gets taxed at the same time. 1 withdrawal, 2 tax consequences. And most people never discover this until a preparer shows them an unexpected number. Even if your income stays flat, this cost grows every year. The thresholds were set in 1983 and have never been adjusted for inflation. So more retirees cross those lines automatically. If you collect Social Security and draw from a traditional retirement account, this is already running on your return. Today, I will show you the formula and 5 strategies to reduce or eliminate what it costs you. Strategy number 2 changes the calculation permanently. Quick context before the numbers. This video is for United States retirees and pre-retirees over 60 navigating Social Security and retirement income. Everything I share comes from official sources. The Internal Revenue Service, specifically IRS Publication 915, and the Social Security Administration. I will name each source as we go. This is educational content only, not personalized tax or financial advice. Before making changes, speak to a licensed tax professional who knows your situation. In 1983, Congress added a tax on Social Security benefits for the first time. Per the Internal Revenue Service, if combined income exceeded $25,000 as a single filer or $32,000 as a married couple, up to 50% became taxable. According to the Social Security Administration, about 10% of recipients were affected. In 1993, a second tier was added, above $34,000 for single filers or $44,000 for married couples. Up to 85% of benefits could be taxed. Before I go further, how many of you receive your Social Security deposit every month and still are not sure how much of it belongs to you after taxes? Drop a yes in the comments right now. I read every one, and your answers shape what I cover next. Subscribe if this is useful. Those thresholds have never been adjusted for inflation, not once in over 40 years. Per the IRS, your tax brackets adjust annually. Your standard deduction adjusts, but the Social Security taxation thresholds were left frozen by design. If that threshold had kept pace with inflation since 1983, a single filer would not enter the 50% zone until combined income exceeded $78,000 today. Instead, the line is still at $25,000 per estimates from the Social Security Administration and the Congressional Budget Office. The share of recipients paying tax on benefits has risen from roughly 10% in 1984 to over 50% today. Now let me show you the formula. Provisional income has 3 components: your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefit. Pause and write those 3 things down right now. That total is your provisional income, and it is the single number that determines your entire Social Security tax situation. 2 thresholds every retiree needs to know. For single filers, $25,000 is where up to 50% of your benefits can become taxable, and $34,000 is where up to 85% can. For married filing jointly, those lines are $32,000 and $44,000. Write those 4 numbers down because they determine everything that follows in this video. Here is how it plays out. A single retiree, 68 years old, collecting approximately $24,852 per year in Social Security. The approximate average in 2026, per the Social Security Administration, withdrawing $30,000 from a traditional IRA with $2,000 in savings interest, provisional income $30,000, plus $2,000, plus $12,426. Half the SS benefit equals $44,426 above the $34,000 single filer threshold per the IRS. Up to 85% of those SS benefits are now taxable. After the standard deduction, including the additional amount for taxpayers 65 and older, federal income tax on the Social Security portion comes to approximately $1,600 per year. If that looks like your situation, that $1,600 did not appear on your Social Security statement, the IRS applied the formula automatically. Every IRA dollar is doing double duty, taxed as ordinary income while simultaneously pushing more of your Social Security into the taxable zone. That cascade is what the provisional income formula creates. For a married couple with combined Social Security of $40,000 and additional pension and IRA income, provisional income can easily exceed $60,000, well above the $44,000 joint threshold per the IRS. Up to 85% of combined Social Security becomes taxable. Federal tax on that portion runs approximately $2,300 per year. Every January, the cost of living adjustment pushes more income into the same formula, generating more taxable income in the same year the raise arrives. Tax legislation signed into law in 2025 includes a senior bonus deduction for taxpayers 65 and older. That is strategy number 5. 5 strategies total, counting down but not in order, with the most powerful one coming last. How many of you are in your gap years right now? The window between retirement and when required minimum distributions begin? Drop your age in the comments. That number determines which of these strategies matters most for you. Strategy number 5. Per the IRS, the senior bonus deduction provides $6,000 per person for taxpayers 65 and older, $12,000 for qualifying married couples. For tax years 2025 through 2028, the phase-out begins at $75,000 for single filers and $150,000 for married filing jointly. At the 12% bracket, that is approximately $720 per year. This deduction reduces taxable income but not provisional income, so it will not shift your Social Security taxation zone. Pair it with income timing to keep provisional income below the thresholds in lower income years. Strategy number 3. If you are 70 and a half or older and give to charity, the qualified charitable distribution may be the most underused tool in retirement tax planning. Per the IRS, you can donate up to approximately $111,000 per year from a traditional IRA to a qualifying charity. The donation counts toward your required minimum distribution, but never enters adjusted gross income and never increases provisional income. Route donations through a qualified charitable distribution instead of writing a check after an IRA withdrawal, and those dollars disappear from the formula. Strategy number 1. Know your provisional income and pull from the right accounts to stay below the thresholds. Per the IRS and Secure 2.0, required minimum distributions begin at 73 for those born before 1960 and at 75 for those born in 1960 or later. Pause and note your own RMD start age, because every year before that date is a year of maximum control. Keep adjusted gross income plus tax-exempt interest plus half your Social Security below $25,000 as a single filer, and 0% of your Social Security is taxed that year. Strategy number 4. Approximately 7 states still apply state income tax to Social Security benefits as of 2026, including Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont, each with different exemption rules. Verify your state's current rules directly with your state revenue department before acting, because laws change. States with no income tax, including Florida, Tennessee, and Texas, eliminate the state layer entirely. Some states, such as Pennsylvania, exempt most retirement income. If you are considering a move, the annual state tax cost on Social Security is worth knowing first. Before the most powerful strategy, let me tell you about Margaret. This is an illustrative composite, not a single real individual. Margaret is 68, a retired nurse in Ohio, collecting approximately $24,000 per year in Social Security. She assumed her benefits were mostly tax-free. The $28,000 she drew each year from her IRA was pushing over $11,000 of her Social Security into the taxable zone, adding approximately $1,300 in federal tax she had never planned for. Roth conversions at 63 would have changed this. The window was open, and she did not know it. If this sounds familiar, what comes next is the strategy that matters most. Strategy number 2. This is the one that changes the provisional income formula permanently. Roth IRA withdrawals do not count toward provisional income. When you draw from a Roth account, that income is invisible to the Social Security taxation formula, not reduced, not counted. Invisible. Convert part of your traditional IRA to a Roth during the gap years, before required minimum distributions begin. And you permanently move that money outside the formula per the IRS and Secure 2.0. That window closes at 73 or 75, depending on your birth year. Every year you convert in that window is a year of lower provisional income for every year after. If you are in your early to mid-60s, that window is still open. The provisional income formula cannot see Roth funds. That is the most important fact in this video. The thresholds the IRS uses to tax your Social Security have been frozen since 1983 and 1993, designed for 10% of recipients, now affecting over 50%. The formula: adjusted gross income plus tax-exempt interest plus half your Social Security. 5 strategies. Number 5, the senior bonus deduction and income timing. Number 4, know your state. Number 3, qualified charitable distributions. Number 1, withdrawal sequencing. And number 2, the most powerful, Roth conversions during the gap years. 3 things you can do right now. Step 3, calculate your own provisional income. The IRS does not send a letter telling you which zone you are in. That formula is now yours. Step 2, verify your state's rules on Social Security benefit taxation with your state revenue department, because laws change. Step 1, if you are in your gap years, speak to a licensed tax professional about whether Roth conversion planning makes sense for your balances and timeline. Nobody is going to contact you and explain you are paying more than you have to. Knowing this formula is what changes the outcome. Which of these 5 strategies do you want me to go deeper on next? Drop the number in the comments. If strategy number 2 gets the most votes, a full Roth conversion breakdown is coming next week. If you know someone in their early 60s with a traditional IRA who has not yet started collecting Social Security, a sibling, a spouse, a close friend, share this video with them today. The gap years between retirement and the RMD start age are the most valuable tax planning window of a retirement, and most people only realize that after those years have already closed. Next week, I am covering how required minimum distributions change this same provisional income formula and what your options look like once that window has closed. If you want to review the formula before then, go back to the timestamp where I explained the 3 components and run those numbers with your own figures. That 60 seconds with your actual income in it is the most useful thing you can take from this video today.